Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right. No extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Andrew McNair. He is the president and founder of Swan Capital. He manages over $300 million in assets. He exited an 8-figure personal real estate portfolio and has 10 plus years of experience in real estate investing, including multifamily, RV parks, storage, short-term rentals, and industrial properties. Andrew enjoys sharing his knowledge with others. He is a public speaker. He's also the host of a weekly radio show called What Your Money Would Say, and a podcast host of Rich, Young, and Powerful. Some of his guests have been Dr. Ben Carson, Larry the Cable Guy, Dabo Sweeney, and many more. Andrew has appeared as a financial commentator with the Wall Street Journal, Forbes, and Fox Business, and has contributed to Market Watch. Andrew is the author of 3 books, Don't Be Penny Wise and Dollar Foolish, Tithe, A Living Testimony, and The Giving Crisis. Andrew, welcome to the show.
Hey, I'm really excited to be on here.
I am excited for you to be on as well. And I typically like to start, Andrew, really with your background, where you grew up and what eventually led you to real estate investing.
Yeah, absolutely. So I grew up in the beautiful town of Pensacola, Florida, one of the most beautiful beaches here in the United States. And my story starts with, at least my financial and real estate journey starts with a book that everyone's very familiar with that has a purple cover by the name of Rich Dad, Poor Dad. And I really took that book to heart because I had a dad that was rich, biological dad that was rich in integrity and in faith and all the things that matter, but not so good on the financial knowledge. He wasn't rich in financial knowledge. His family didn't bring him up to know all these things about finances. It wasn't talked about. It was a taboo subject. And then I had a lot of rich friends, and I really connected with that book because I lived it by going to a private school. And so I was really interested in money. And I started interning at a financial firm at the age of 14 all the way till when I was 18. And I started investing in the stock market first. And I fell in love with the stock market. I put in $62,000 waiting tables from Denny's, only to double it in a year and a half where I had $142,000. And the story goes that I was about to buy a duplex. Actually, it's still across from the church that I go to every Sunday. And I was about to buy this duplex in cash at the age of 18. And one of the best things that could ever happen happened to me. And that was that I lost every single penny. I made a really ridiculous, very aggressive stock trade, and I lost everything. And it was one of the best times of my life because as I was screaming into my pillow and punching my mattress as hard as I could, I fell into a trap of connecting my self-worth with my net worth. And I learned that, greed is a serious problem that I struggle with. So I understood that at a deeper level and a spiritual and mental level. But I also learned from a financial standpoint how important diversification is, because if I had bought some of that real estate, I'd have paid for that house in cash. I would have still had my stock and equities, but I would would have owned a house paid for. So again, it was just a mistake that is priceless to me. And now I've given advice to thousands of retirees here on the Gulf Coast. And I'm so much better for that failure that happened in my life. And I'm thankful for that failure at this point. Again, a long time of recovery at looking backwards.
Yeah, yeah. I would say it must be a long time of recovery between that, because you have turned it into a positive thing for sure. But I'm sure at the time you weren't thinking, "Man, this is the best thing." But that's sometimes how those lessons go, right?
It's
It's something you
exactly.
look back on and say, "Wow." But to really to convert and have actually put away 62K, just being a waiter at Denny's, that alone is kind of a pretty cool deal as well. I mean, you don't hear very often somebody taking, their tips and being able to invest it in the stock market like that. So
Yeah.
kudos to
I
you
think,
from right
we
at the
we
very.
we try to tell kids like, enjoy your childhood. And I'm always like, why? I mean, adulthood is amazing too. So I'm big fan if you have kids to get them out working as early as 14. Like in the state of Florida, they can wait tables at the age of 14. And I was making $14 an hour when I was 14, many, many moons ago when I was 14. And so it's sad that we baby our children a little too much so that they miss out on these great experiences and they are able to invest in the stock market and invest in real estate earlier. And so if you're a parent out there, push them to go out there and maybe get their first waiting the table job, the first server job.
Yeah, for sure. No, I think there's a lot to be said there for sure. And I like what you had to say about, kind of reflecting on your self worth, kind of being
Mm.
tied to your net worth and the lesson that you learned with respect to that. So that's neat. So unfortunate made an unfortunate decision, but it ended up giving you a life lesson, if you will. From there, what happened next in your
Yeah,
story?
absolutely. So once I picked up all the pieces of myself and of my finances, I actually turned to real estate in a big way. I started my wealth management firm out of my truck, which was Swan Capital. So out of my Camry, I was asking families to invest in a kid that had to grow his goatee out, and they were giving me $500,000 checks, $250,000 checks to go and invest. And I was working out of this Camry, and I had a lot of early success again, with the wealth management firm. And I thought, hey, I'm investing alongside clients in the stock market. My income is tied to the stock market and my investments are tied to the stock market. I'm still not diversified. So I started buying houses. And again, it was one of the best times in history. It's not because I'm brilliant, but I started buying houses in 2010. And so I got up to 52 duplexes, triplexes, quadplexes that had mostly paid in full, and I renovated them all. They were really, really tough properties, C properties at best. And it was 136 units. And I thought, wow, this is really amazing. But that greed started to come back again. And I started to connect my self worth with my net worth. And I talk about in my book, The Giving Crisis, how I ended up giving all of that net worth and money away and gave away all those houses. But it was one of those learning lessons that, originally I wanted to have 200 houses, but the more houses I accumulated, I actually started getting more and more stressed out. I had decision fatigue and I started to worry about like, who's going to paint this house? Who's going to fix the plumbing here? And then this tenant did this. And it became such an overwhelming situation that I thought, I've enjoyed a chapter of life where I was able to invest $3 million and turn it into $10 million. Maybe it's a time for passive real estate investing. And that's when I sold all those properties, gave all the money away. And then I started Signet, CYGNET, a baby swan. And our Signet fund is where I wanted to bring clients along with me on the journey of real estate investing. And we started investing in properties like storage units, short-term rentals, flex industrial, and apartment complexes, because all of those individual properties types actually act differently depending on the economic cycle. And we've had great success. We're on a pace to raise roughly around $20 million in this year alone for Signet. And it's really fun to bring clients along who have sometimes never invested in real estate, and some are real estate moguls. But when you get into your 70s and 80s, they get that decision fatigue that I was very, very well informed about with my own properties.
Yeah, yeah. And so on that Signet fund, it's investing in all of those various asset classes, so that somebody who's investing with you is truly diversified. And it being a fund, it's kind of diversified amongst all the various investments within the fund as well. So it sounds like it's pretty neat deal. Tell me a little bit about, for maybe the audience who isn't necessarily familiar with, obviously they've heard of RV parks and multifamily, but what are some of the differences? You mentioned kind of about the onset that they don't necessarily trade at this, at the same, depending on the economics. Tell me, what are some of the differences, and what do you see as some of those differences when times get a little bit tough, interest rates get a little bit high?
Yeah, our investment thesis is that apartment complexes are available during good and bad economic times. People do need a place to call home during good and economic booms, and as well as bad economic times and crises. But they also are going to fluctuate differently than what flex industrial, which is where business is done on a regular basis. So a flex industrial is, if you're not familiar, is an office in the front and a warehouse in the back. And so business is done there. Even with the trend of work from home, flex industrial has done really well, because if you own, let's say, a flooring business, you need a showroom in the front, but you need a warehouse in the back to have all the material. So flex industrial is really great to have. But then on one hand, we have things like storage units that actually can do better during recessions, because people are getting foreclosed on, they're having a life change, they're moving or downsizing because of the economy. And then on the other hand, we have short-term rentals, everything from the Poconos to Arizona to Gatlinburg, because during good economic booms, people are more likely to have discretionary cash. They can go travel more. And so we wanted to cover our bases for our clients from having 4 different asset types. And that comes from my realization that I was investing in one type of real estate. I was investing in duplexes, triplexes, and quadplexes, which is all multifamily. And again,
Right.
maybe I just got lucky, maybe I'm blessed, but I bought at the right time in one type of asset class. And the other thing that happened to me is I invested in one area. I invested all here on the Gulf Coast, what I knew. But my family was not diversified. We didn't have Midwest properties, friendly West Coast state properties, and definitely just here on the Gulf Coast, but not the whole Southeast. And so that's what we've integrated with Signet to give us more diversification.
Yeah. Okay. And so what states are you investing in then?
So the states that we're invested in, we again, Midwest, friendly West Coast states. Again, a great example would be we just invested in Salem, Oregon in a storage unit. Why? Because we don't want to get trapped with certain rent control states. But if they don't have rent control, for example, on storage, we're still having really nice upside ability to raise rents, but we're steering away from those states that don't make it friendly for owners like us. And we don't want to have too much in Texas. We don't want to have too much in really any state for that matter, because we want to make sure that we're truly geographically diversified. And I do think that's important, because so many, different firms are just focusing in one state, which is important. But when you're managing institutional capital like we are for retirees, it's important to add even more diversification than just property type.
Yeah, for sure. Well, and so Andrew, you went from basically, with your wealth management firm where you're primarily investing in the stock market to now, you're investing in real assets. What was the personal leap that allowed you to be able to, go from somebody who knows stocks to now all of a sudden saying, wait a minute, let me jump into a totally different asset class here?
Yeah, one of the best financial books that's ever been written is Unconventional Success by David Swenson. And it's sad that he's passed away, because he's a legend and one of the best underrated money managers that has ever lived. And he managed the Yale Endowment. And so it's so important to follow success, because it leaves clues. And when you see someone like David Swenson, who's grown the endowment from 4 billion to over 40 billion, with less, risk and correlation to the S&P 500 than many other money managers, you think, well, I need to learn more about that, especially for my retirees, because retirees are a lot like endowments. If you think about it, retirees, they need income along the way. They don't know
Mhm.
how long they're going to live, and they need to be conservative. Well, that's just like a college. They need donations along the way, but they are also making capital improvements along the way. A college could be around for 200 years, and they have to invest conservatively because it would be on front page news if the Yale endowment had lost all of their endowment with a speculative investment. And so if you look at an endowment model of money management, you're going to incorporate equities. You're going to incorporate fixed assets. You're going to incorporate real estate and private equity and energy. And when you do that, you're providing and building, like Ray Dalio says, an all-weather portfolio that is prepared for all seasons. And so it was always my dream of making sure that clients were truly diversified enough that they could weather any season that came upon them, any black swan, pardon the pun with Swan Capital. But we wanted to, create this all-weather portfolio for each and every client. And that's how I wanted to incorporate real estate and why we have.
Okay. And so, as you looked at investing, did you invest as a limited partner with somebody who was already an operator, or how did you choose those specific assets, and who did you choose to pair up with?
Yeah, it's a needle in a haystack. We have to go through a lot of operators to decide who we're going to invest in. Now, because of the capital that we're raising on an annual basis, of course, we can negotiate some really nice class shares for our clients on behalf of them and pass on that scale to them because we're coming in with $1 million checks, $500,000 checks minimally a lot of times. So we can really get scale. But we have to have a really nice due diligence checklist where we're looking at the track record and we're looking at the performance. We're looking at that performance compared to what has been projected before. We're also looking at a creep of, going outside of their specialty. There's so many things that we're looking at in that due diligence. We're also doing really thorough background checks to make sure that these people are not felons. You'd be shocked how many times we've run background checks on operators that have some really crazy backgrounds that obviously when we're investing in institutional money, we cannot take those risks.
Yeah. And so is the investment itself, is it like a fund within a fund that Swan Capital has, like, so you're placing X amount, say call it $500,000 with another syndication, or tell me exactly what's the
Yeah,
structure look
we're
like?
investing directly into syndications. We don't invest in a lot of funds. We're not opposed to investing in other funds, but we a lot of times are investing directly into syndications. And
Right.
again,
Yeah.
because of the scale that we're coming to the table with, we're getting the highest class share and negotiating that even further to make sure that our clients are benefiting. And that's the point of operating. Every time we operate in a fiduciary capacity for clients and investors, we're trying to say, how do we eke out as much return for our clients that we can?
Yeah, makes a lot of sense. Yes, because you're bringing a lot of money to the table for each of those syndications, and so they're willing to give you the best share class. And quite honestly, you have the opportunity to pick the best, jockeys within the business as well. And so that's fantastic. And so, how long have your funds been in place? And tell us a little bit more about what you see with those in the future. Are you tending to continue to diversify amongst those various asset classes pretty evenly, or are you favoring one or the other as we move into the future here?
Yeah, a lot of good questions there. We've had Signet for coming up on 3 years, and we try to be very agnostic with, having too much in one allocation. We're okay with tweaking our formula. And again, every vintage is going to be different. 2024 is going to be different than 2025 vintage and 2026 vintage. So we're okay with bending those allocations, but we don't want to be 90% multifamily and 5% in the rest. That's not going to work. but we want to make sure we keep an open mind and look at the market and make sure if there's no opportunities and the opportunities that have been presented, if they don't meet our certain thresholds and they don't fit in our buy box, that we're going to have to pass on those until we get our allocations where they need to be. And so right now we're hovering around close to 25% in each of those. And I'm really happy to see that diversification mix for 2024 and how it's shaking out. In 2023, we're probably a little heavier into multifamily, but we definitely enjoy having that diversification of the flex industrial because it allows us to have a higher cash on cash return for our clients along the way. And instead of just waiting for nothing but appreciation and selling in years, hopefully 3, 4, or 5.
What do you think about in flex industrial that's allowing those little bit higher distributions and stuff along the way versus waiting for the very end? What do you think's allowing that to happen in that particular asset class?
Yeah, I think there's a lot of different market factors. I think what is attractive to me for flex industrial is the tenant diversification. I think what's really handy is, people have been so tough on commercial and wanted to stay so far away from anything that looks like commercial real estate that you're seeing higher cap rates because of that. And the more I have a lot of clients that ask me, are we investing in commercial office space? And I say, because so many people are asking, it makes me think that I want to invest more in commercial because if everyone thinks it's a bad idea, it's probably starting to become a really good idea at that point. And that's usually the depths of a cycle or a valley is when, my Uber driver thinks that commercial office space is a bad investment. It's usually the opposite to be true. And so flex industrial is seeing higher cap rates also because there's a lack of supply. I mean, a lot of people are not building flex industrial. And so you're seeing this in a lot of markets where the demand's there. The demand is in some places actually increasing and the supply is staying stagnant. And we're being able to buy some of these properties cheaper than it would be to rebuild them. So that's actually, helping us because even if new supply comes in, we're still buying at such a great price. So there's a lot of reasons why we love flex industrial.
And are you tending to buy existing flex industrial or is it development?
Yeah, these are all value add properties, and that's pretty much our MO for that across the board, from storage to all the way to multifamily, short-term rentals. There is a lot of value add. We're taking a little bit more risk there. We understand that it's going to take some sweat equity, but we're willing to do that.
Okay. And so when it comes to some of the opportunities, let's say for storage, for instance, what are some of the value adds that you typically like to see in an opportunity?
Yeah, we just worked on one where it was a conversion from a retail facility into a storage unit. And I think those are really cool opportunities anytime the market demands more storage. Per capita to the population, and we can come in and take a Piggly Wiggly and convert it to a storage unit. I think that's a great opportunity. So anytime we can do that kind of value add where we're repositioning it, recharacterizing that property, I think that's a really good opportunity.
Yeah, for sure. No, it makes sense. Okay. And then what are you seeing with short-term rentals? Obviously, going through COVID and coming out of COVID, it was seemed to be very hot. And then if you read the headlines, you would think that it has kind of simmered out now, but that may not be the case. So what are you seeing with within the portfolio that you're looking at? And is there a specific area geographically that you feel like seems to be really strong on short term right now?
Yeah, I think that again, there's ebbs and flows of the cycles, and I think at the end of the day, it comes down to execution. It's nice to ride the waves, but you have to know how to take advantage of those waves. So if we're investing in an operator that has an average daily rent way above their peers, they're executing on the daily operations, they're picking better markets to invest in, and they're looking for gaps in the marketplace because they're tracking the metrics. They're actually bringing really nice experiential properties to market where they can actually charge more than their peers. All of that, if it's well executed with good property management, then you can see some really nice superior returns. And that's again driving up that cash on cash return on the properties that we can really pass those dividends to our clients. Again, a lot of our clients are retirees, so they want to see a blend of cash and distributions coming to them instead of waiting 5 years, because when you're 65, 5 years from now seems like a long time.
Yeah. And so from an investor standpoint, if somebody buys into one of the funds, what is the typical hold period, and what's the exit strategy if there is one?
Yeah, absolutely. So with Signet is a 5-year hold, and we're starting with quarterly dividends in the first quarter. And so clients would invest a minimum of $100,000. Then they could invest as much as they want. I have 1.8 million of my own money in Signet, so we believe in eating our own cooking around here. Same with our Swan portfolios. The Swan portfolios that we invest for clients with their Roth IRAs, their 401ks, we manage our own portfolios. We don't use a third-party money manager. We manage that in-house. And I think that's one of the biggest differentiating factors is if you invest with anyone, you should ask, show me your balance sheet, show me your financial plan, show me your net worth statement, show me how much you're investing in this deal. We should always remember when we take advice from someone, we're basically trading places with them. I think one of the reasons why clients trust our firm is because they know that we have skin in the game. We eat our own cooking around here. And that most of the time when they're taking advice from us, we have a higher net worth than they do. And it should be that way. We manage money for a living. We should know how to manage our own investments. And I think that's what we need to start demanding from our advice givers and who we invest in.
Yeah, no, it's a great point, and it's kind of the opposite when you look at not to throw any names out there, but certain financial advisors. It's a lot of times somebody advising you that does not have the net worth that you'd want. So just kind of crazy.
Right. Or even the asset mix, right? Like there's many people that are like, no, real estate only, no stock market investments. Well, I'm not going to take advice from that because that's a different philosophy for me. Maybe it's a philosophy that you follow, or whoever, if you're listening, that's what you follow. I personally have lived thousands of lifetimes watching what works and what doesn't. And for multimillionaires, it's really significant, I think, to have a blend of equities that are publicly traded, private equities, real estate, both passive and active, and have fixed investments, again, the older that you get. And so I think that's really important. And again, many times it's better, it's easier to market if I'm a Grant Cardone, I'm a Kiyosaki, I'm going to market that there's only one way, and it's black and white. Life is rarely black and white, but it's good marketing. And what I've realized when you're sitting across from a client giving them advice around their situation, it's not black and white. They need to have some gray, and it needs to be a mixture.
Yeah, no, I totally agree. Well, let's go back maybe to something that you said at the beginning. You had this portfolio, fairly large portfolio, and you mentioned kind of giving it away. Tell us a little bit, maybe elaborate a little bit more on what you mean by that. You had this, lots of small multifamily, and at some point, did you liquidate it? What do you mean by give it away?
Yeah, absolutely. With my faith and what I feel called to, I just felt this burden that, I've been so blessed and I've had so much success that I have this inner drive and this ambition that's really driven over people at times, and this ambition to make more and have more. And what I've realized is that is so unhealthy. We continue to push the goalpost of what success is. And the only way that I know that has worked for me is to give it away. It takes all the steam out of my unhealthy ambitions, my unhealthy greed. And I'm actually listening to a great podcast lately of Founders. Founders podcast is amazing. It just tracks all these billionaires and millionaires that that are common family names, and they've destroyed their families, destroyed their life. But by the world standard, they're successful. And I think
Right.
how sad to get to at the end of your life and gain the whole world, but lose your soul. And I thought, that's not going to be my story, that I am going to be poured out and I'm going to take my investments that I've made a lot of money on, and I'm actually going to give it to my charitable LLC. I'm going to get tax benefits for it, but that's not what I'm doing it for. I'm doing it because I want to give that money away to the things that I find dear, that the tragedies of this world that I want to fix, and that I want to be the stopgap. I want to be the means to end to some of these things that need to be fixed in this world, instead of just complaining, hoping my vote is going to fix the world. No, I'm going to actually put my money where my mouth is, and I'm going to try to fix it myself. And if we all started to do that, I think you would see worldwide change if it just started with me and my own personal economy.
Yeah. Yeah. No, I totally agree. And so so tell me a little bit more about your nonprofit that you've put these, so did you just roll the properties into it, or tell me a little bit about,
Yeah.
what
So
what
I
it is, and
literally,
what do you see as far as, what do you see that helping or doing?
sure. Again, this is not tax advice. You should meet with your own CPA. You should meet with a tax attorney. But this is where I was able to give my properties over to my charitable LLC. You could do this to a donor advised fund, and I was able to give that property over. And there's other different tax strategies that do very similar things. And I was able to give that appreciated asset over, and I didn't have to pay any taxes on the capital gains. I was able to take that tax deduction and use it against my income. And so again, if you're a seven-figure income earner or higher, you're able to take that, give it to a cause that you care about. My charitable LLC is called Luke 16:11, which says, if you can't be trustworthy with earthly wealth, who's going to trust you with eternal riches? And it's actually one of the coolest parables in the Bible, because Jesus actually uses actually an anti-hero. He uses an anti-hero to prove his point, which is incredible. And so I love that story. And so that's why I named it that way. And so what I do now is I've been giving about half of Swan Capital's profits away to that charitable LLC going forward. And that's great. It gives us a tax deduction. But at the end of the day, it allows me to funnel that into like a donor advised funds, the same strategy of putting money into a bucket that I can give to various causes down the road that I want to, give it to it immediately, or a combination of the both. So again, I don't have to decide where all the money is going. I can still invest it within that donor advised fund, for example, or the charitable LLC. And it allows me to be able to give to those charities and those causes that I care about in a structured manner instead of all at one time.
Yeah, yeah, makes sense. And what are some of the things that you're trying to do with this, with this charity? In other words, I guess what are some of the benefits to, whoever the charity is supposed to be benefiting? Not the tax benefit for you, but like
Yeah, the
what are you
causes I
trying?
care about,
What
you're
kind of a
asking?
change? Yeah, yeah, exactly, exactly.
Yeah, the causes I care about is those that have been dislocated based on maybe a war, like a refugee. So that's really important to me. It's very important to me to have drinking water as well as food for those in third world situations. It's very important to me because of my faith that there's unreached people that I would like them to at least hear the name Jesus and make a decision if they believe in him or not. So that's really important to me. So I actually give to Samaritan's Purse, which does really good, meaningful work for underprivileged families all over the world. I give to an organization called Radical. I give to an organization called Word of Life Ministries. There's many, many great causes out there. And the nice thing is we have technology that just didn't exist. Charity Navigator is a source where if you're really like pessimistic about the world and you think, well, I don't know if they're going to give it to the right places. Well, that's why Charity Navigator exists. It'll tell you how much goes towards administration. And so many people like to throw stones at glass houses and say, well, those people don't manage it very well. But when they look in the mirror, I found that most people don't manage money very well, but they expect more of organizations than they expect of themselves, which I think is ironic, but I digress. And that's a whole nother point. But I think it's really important to start giving to worthy causes because that's how I found a lot of joy. Like, I think there is and I talk about this in my book, The Giving Crisis. I think there is an epidemic of depression, anxiety, and suicide. And oftentimes we just say, well, we need to make it easier for those people. We need to make it a situation that's a safe space to talk these things out, you do. But also we need to talk about that giving and volunteering and serving might be a solution because it takes the emphasis, the mirror on ourselves and starts putting it on causes that are bigger than ourselves and people that are actually going through potentially worse trials than we are. And then maybe, just maybe, that'll actually improve our mental health.
Yeah, yeah. No, that makes a lot of sense. Yeah, if you don't mind, maybe talking just a little bit about your book. And obviously you got three of them, and so maybe staying on the giving crisis. Is that kind of the main point with that? Is just that look that can help you find direction and joy within your own life if you find something that maybe is bigger than you.
Yeah, I mean, some people might think it's an exaggeration, but I truly think it's a giving crisis in this country that we're one of the most wealthiest, wealthiest generations, points in economic history in the world of all civilizations. We're one of the wealthiest. What people say, if I could go back in time, I'd live in a different time. What time would you like to live in that's better than this one? This is one of the best
Yeah.
peace times of history. And we've been, again, one of the wealthiest times in U.S. history. But here's what's sad. If you go back to the Great Depression, I spent a year living with my grandfather, who was 93 at the time, and we talked about the Great Depression. This man lived the Great Depression, and we used to take 3-mile walks on a daily, and he would just unpack to me what it was like to live in the Great Depression. And what I told him after doing my research for this, ultimately would be in the giving crisis, is the average person gave 3% of their income away during the Great Depression. But today, during the Great Expansion financially, where we have double income households, inflation has not beat income, and we should be wealthier than ever and have more discretionary income than ever, yet we give only 2%. And I do think there's, again, a high correlation that we actually have less kids, larger houses, yet we still feel unfulfilled, even though we've been filling our houses with more stuff. And so I think we eventually have to call time out and say, maybe what we've been doing is wrong. And maybe we have to say, this American dream has started becoming American nightmare, that maybe we should simplify, live maybe a quieter life and start giving to people that are less fortunate than us, which is great because it takes the pressure off the government trying to tax everybody because, communism and socialism is obviously not the answer. So when we give as a community, that's what it's all about. That's why the government gives tax deductions, because it allows the person to say, hey, I see a need and let me go fix it. And if we get back to that where we're fixing the problems in our community and we're giving money to fix those, then the government doesn't have to get their head in there and try to fix the situation because they can't fix it because they're too bureaucratic, and I won't go any farther. But that's what I'd love to see in this country, and that's why I think it's a crisis.
Yeah, no, it makes a lot of sense. And I think you have a little bit more autonomy over what you're going to give to, where if you wait for the government to do it, you just don't have that. So
Yeah, I mean,
how
they're going
about
to send your money to places that you don't like, which is probably Ukraine, and they're going to send missiles over to Russia. So if I can give it to somewhere else where I see a bigger need, like, again, this is why if you're watching this as a video, I'm in a t-shirt. I'm usually in cufflinks with a pocket square. And today we actually took time out of our team schedule. We shut the office down for a half a day, 4 times a year, to go volunteer. We pick a different charity every year, and we invite our clients in to go serve the community. And so we help the Dream Center, which helps out with homelessness and human trafficking. And so I saw the need today. I saw 60, 70 homeless people that are struggling with mental health, and I can feed them. I can show them, that I care about them and look at them in the eyes and say, yes, ma'am, and yes, sir, and show them that I care about them as a person. And again, when you start doing that small little changes, and you're like, well, does that really change anything? It absolutely changes everything for that person, which ultimately is a ripple effect.
yeah, yeah, for sure. No, that's great. Fantastic. How about your book, Tithe, A Living Testimony? Tell me a little bit
Yeah.
about what is that all about?
Yeah, I mean, it may, if for the audience that, is not a believer, it may not make any sense. But, my personal belief is that we should give 10% to the local church. And that's become controversial over the years because, greed is rampant. We don't want to give 10% to anybody, let alone feel like I have to give it to a local church. And my personal humble belief is that's where we should start. And then what I teach in the book, The Giving Crisis, is as your income increases, don't stop at just giving 10% to your local church. Start giving as your income increases to the charities and the organizations that you care strongly about. Because I didn't start giving away half my income from the start. What I did is I started, with 10%. And as my income grew from Denny's, for when I was making $14 an hour to when you're making, $2,000 an hour, what I started to do is instead of increasing my expectations, increasing what I spent on, I started increasing my giving and my savings. And that made all the world of a difference. I mean, the modern classic, The Psychology of Money, Morgan Housel talks about that our earnings doesn't keep up with our expectations. And that's so true. I mean, who doesn't remember their first raise, their first promotion, and immediately when they got that bonus check, it was gone. Like it was already spent. It was like the Christmas Vacation all over, that movie from the National Lampoons where Chevy Chase has already spent the bonus that he doesn't have. And instead, if we start giving away those things and we start actually not moving the success goalposts that we have in our life, we're going to have more fulfillment and more purpose, which is what man's search for meaning is all about.
Yeah. Yeah. No, that's great. That's fantastic. Yeah. And I think you got to start when, you're at Denny's, because when you're making a little bit of money, if you can allocate that 10%, then it makes it a heck of a lot easier to do when you start making a whole lot more. It's just it's learning that habit. People would think it'd be kind of the opposite of that, right? It's like, well, if all I got is these tips from Denny's, how am I going to be able to afford to pay rent, to do all this other stuff? But if you can kind of manage that from the beginning, then you learn how to do it when the dollars really start to count.
I think you're spot on. Jim Rohn once said, everyone says, hey, if I just had $1 million, then I would give. And he said, maybe the good Lord's just testing you with the first $50,000, $80,000 that you're making right now. And maybe you say that you would give if you had that money, but you have money now and you're not being a good steward of it as much as, and again, all of us could say, hey, I could do a better job in that. I'm not poking, fingers at and pointing fingers at anyone, but all of us, we have to start somewhere. And if I had to start now giving 10 or 50% of my net worth, I don't know if I would do it. But I know I've actually proved that the more you give, not necessarily the more financially you get back, but definitely the more fulfillment and the happiness you get back. I mean, how do you put a price tag to that?
Yeah, no, for sure. That makes a lot of sense. How about last one on don't be penny wise and dollar foolish. What's kind of the basic principles of that book?
Yeah, I wanted to go after certain sacred cows that people talk about. There's certain investments that people say, oh, you shouldn't invest in. There's certain concepts like I should always pay off my mortgage. And so what I did is I just went after some very, critical sacred cows in finance. And I wanted to talk about the opposite side of the argument. And I think that's always a good idea. Whenever someone is saying, you should always pay off your mortgage, you should always do this. Again, be careful from the person that you're taking financial advice from, because like I tell many of our clients, you only do this once in your lifetime. Like you only retire once. And the person that's giving you your advice, they have no professional recourse. They don't have errors and omissions. They're not giving you a room in their house if they give you bad advice. And so many times we take advice from friends and family members. Maybe they're even successful. Shockingly, I've seen people take advice from someone that's not successful financially, which is even more mind-boggling. But when you take advice from someone that is successful, maybe, just maybe, they did it by sheer luck. They were at the right time at the right place. And here you are trying to reproduce it, and you might not be so lucky. I mean, a gorilla can flip a coin 7 times, heads, but doesn't mean that the gorilla's got something, baked in. It could just be a lucky gorilla. And that happens so many times in different asset classes where people follow a guru, and maybe it's worked a few times for them until they've had, again, hundreds and hundreds of clients that have reproduced it. You don't know if it truly works.
Yeah. No, that's great. Cool. Sounds really good. Well, Andrew, if somebody, thanks so much. This has been really good. I've really enjoyed having you on the Wealth Flow. How can people find out more about you? Maybe if you want to talk a little bit about your podcast as well, and the radio show, where can people find out about you?
Yeah, our website is swan-capital.com. So it stands for Sleep Well at Night. So a lot of people think it's my last name. My name's Scottish. It's Andrew McNair. So again, swan-capital.com. It's easy to find. But also, please do check out my podcast. The podcast is Rich, Young, and Powerful. I've had Kurt Warner. I've had musicians. I've had business owners. I've had the founder of Ritz-Carlton, for example. I've had Horst Schultz, who's Horst Schultz. I've had Hobby Lobby's CEO. I've had some really cool people on our podcast that all are philanthropists in their own right. And I bring them on so that they can share about their charity, their cause, their organization, and why it's so important to give towards their cause. And I'm informing people about causes that I didn't even know about. And so I'm bringing on people that a lot of people would say, man, don't meet your idols, don't meet your mentors. And I've met some really cool pastors and musicians. And I think, man, these people are incredible people and they're doing incredible things. And you can join their front. You can join their organization and giving towards it and be a part of the cause that they're trying to fix. So Rich, Young, and Powerful on Spotify and iTunes.
Okay, perfect. Sounds good. And Andrew, I've got two other questions that I ask every guest. One would just be, any advice you would give somebody who is just starting out in their investment journey?
Yeah, what I would say is, first and foremost, is the rich invest first and spend what's left over. The poor sadly do the opposite. They spend first and they invest what's left over. And I would encourage you, if you're young, to invest aggressively and spend conservatively. We make finance far more complicated than it has. Wealth and health have a very good parallel, and it's all about inputs and outputs. A lot of people, they play good offense, but they play very poor defense. And so you make a good income, but you spend too much and you don't invest aggressively enough. Well, you're not playing good defense. And then vice versa. I know people that focus and they over-index on the investments, but they don't make a lot of income. It's because, I hate to face it, some of us are not that good of employees, and we could work on being better employees. We're not that good of business owners. We don't have that good of a business because we don't work on our business. And so we got to focus on the income and, the offense and the defense, both.
Yeah. No, that's great advice. How about I know you've already thrown out a couple different books here, but and we've talked about your own books as well. But how about a book recommendation? Doesn't have to be real estate related, but certainly can be. But just something you've read that's been impactful.
Yeah, one of the best business books I've ever been given, and I recommend it all the time, is The Road Less Stupid by Keith Cunningham. It's one of the best titles ever. Again, I tell people trial and error is a poor teacher. Don't do that. Don't do trial and error. Learn from other people's mistakes. And one of the biggest mistakes that most business owners and most people make, including myself, is we don't think. I know that sounds, you're going to think, well, this guy's really dense. We don't think. We don't schedule time to think. And so that book actually teaches you to schedule time to think. And it gives you questions, if you're a business owner especially, of questions to ask yourself so that you can start thinking about your business in a different light and come up with new strategies. And I think you'll see that from many famous founders throughout history, is that they were big thinkers about their business and they made it a point to think about their business instead of just doing the business.
Yeah. Okay. Great recommendation. All right. Well, thank you, Andrew. This has been good. I think we'll call it a show. Thank you so much.
Thanks for having me anytime.
Awesome.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.